Welcome, this is BloombergQuint. Well, it's been a strong quarter for Mphasis, and well, to take us through the earnings for this quarter as well as what we can expect going forward, I'm in conversation with Nitin Rakesh, who heads Mphasis. Nitin, good morning and thanks for taking the time out. I want to start off with your growth for this particular quarter as well as the outlook, but I want to break that up. So let me start with your direct international business. How are you seeing things pan out here, and what has been Blackstone's contribution, if at all, for this particular area of your business?
Sure. So I think, firstly, the overall growth in the direct international business is probably the strongest it's been in many quarters, both on a sequential basis and, of course, on a YOY basis. I think to kind of look at about a 5+% sequential growth and almost a 17% annual growth in constant currency terms in that business, I think is something that we're very pleased with. If I break that down into segments, I think the direct core business, which is almost with 80+% of the direct international business, this is kind of the fifth straight quarter of 15 to 16% growth in that business on a YOY basis, and of course, this quarter it was 4.5% sequential. If I look at the direct core business growth, I think all the three segments from a client segment perspective have grown well. Our top strategic accounts have grown in a double digits. Our new logo acquisition, or the new client revenue as we call it, has grown 80+%, and our Blackstone channel revenue has grown 50+%. I think at this point in time, Blackstone channel revenue is just over 5% of direct core and about 3.5% of the overall company revenue. But the trajectory has been fairly strong, and we've acquired new clients this quarter, and of course we've grown existing relationships as well. And I've constantly said that the outlook for that segment is that it can continue to show well above company growth rate for the foreseeable future. If I then look at the regional growth, of course Americas have grown healthy double digits, but Europe has actually been the fastest. We've seen the fastest growth from Europe in the last 5 years in this quarter. And that's a combination of three things. Firstly, I think there was a lot of macro uncertainty that seemed to have gotten cleared up a little bit over the last couple of quarters. More importantly, the changes we made to our own leadership and our strategy in the region has helped. And of course, some of those deals that were in the pipeline started converting over the last couple of quarters and are now showing up in revenue. So we're very, very pleased with the new engine of growth with Europe. And thirdly, if you look at the sectoral performance in direct core, we've seen very strong growth from banking and capital markets, as well as insurance and emerging industries. So all segments of our vertical segments have actually grown healthy double digits as well, and that's something that we're very, very pleased with in terms of our sectoral performance.
Okay.
The other element of direct international is digital risk. I think we've been on a growth trajectory there for the last 3 quarters since the beginning of FY20. We called for getting back into our previous stated range of 28 to 30 million a quarter. We broke through that range this quarter. We still see decent runway for sequential growth, at least for the next 3 to 4 quarters. So we're very pleased with the structural shift we are seeing in that business, besides the cyclical back tailwind. And the structural shift is the better integration of the business, better ability to use those capabilities with our direct core customers and vice versa, and effectively making that a much more integral and sticky part of the overall business mix. So I think it's broad-based performance across geographies, client segments, and industry verticals.
Okay, Nitin, so if I come to your HPDCX business, the response here is a little more mixed. While there are a few investors and traders who are actually looking at it positively, there are some who expect some headwinds, some challenges to come through, and this is also to a certain extent to do with the leadership as far as your HPDCX is concerned. My question then is, what's the way forward here? And secondly, if you could tell us anything about any plans for divestment in this business.
Sorry, divestment in the DXC business, you mean?
Yes.
I think they announced plans to divest some of their segments, but we already talked about that last quarter. From our perspective, I think this is a refreshed approach from DXC over the last 2 quarters. They also announced their results overnight and talked about actually they've seen for at least the first time in many quarters they've seen strong sequential revenue growth, And at the same time, they've also guided for a renewed approach towards investing in the business and a technology stack that actually makes ITO business, which is their core as a foundation, and goes all the way up to advisory. So I think there's a lot of renewed enthusiasm. They're investing in the business. Their focus is on their end customers and transformation. And I think we have a complementary set of services that actually can help them aid that transformation with their customers, especially in the application stack. So we feel good about the business. We've worked very hard with them over the last 3 years. We have very strong grassroots level relationships, understanding of their end customers, and the ability to use our portfolio to accelerate that transformation. So I think, and again, I've been very consistent about the fact that that there has been a little less appreciation of the transformation we've applied in that business, by the street. And we'd like the investors and the analysts to take the time to understand how complementarity can continue to work here.
Okay.
So from our perspective, I think that's our approach, and we'll continue to stay very focused on staying relevant to DXC and to their end clients.
Okay. Then a final question then, Nitin. It's on the cost of talent at this point. And while the industry is changing, there is also a requirement of new skills. My question really is to do with an anticipated pressure on near-term margins as you onboard more talent so as to address some of the new businesses and the expansion that you are looking forward to over the next year or two. Can you give us an idea on this?
Yeah, I think, again, this is not something that has come up now. It's been part of our journey since, I would say, the last 3 years. We started a program called Talent Next, which was about reskilling and refreshing our talent pool. We set up architectural communities. We've talked about design thinking as a core principle. And the pivot that we made towards architecture, engineering, and design has been very much part of our change DNA. Of course, the talent market, especially in the U.S., has been fairly tight. Some of that, played out in the industry, I would say, over the last, 3 or 4 quarters. We are very, very pleased with the way we've optimized, the way we onboard talent, the way we use IP and automation to take care of some of these headwinds. And most importantly, our service mix and the way we go to market enables us to have, good pricing power. And that becomes the biggest, tailwind to counter against the whole talent issue.
Okay, Nitin. Well, we'll leave it at that. Thank you so much for joining us and talking to us here on BloombergQuint.
Thank you so much.